Hey everyone, Mitt here from Foundation Capital Private Real Estate Trust. In today's video, we're going to talk a little bit about CMHC financing, why are people getting into it, and, just answer some stuff that might be on your mind. Let's get into it. So what is CMHC financing? Well, CMHC has two different programs. You've got the CMHC Standard Rental Housing Program and the MLI Select Program. Today, we're going to cover the multi-unit CMHC Standard Rental Housing Program. So this is just straight from the CMHC website. Basically, the CMHC mortgage allows lenders to provide better financing to borrowers in multifamily buildings. And it can be used either for construction financing, purchases, or refinance. And typically they're looking at units that are at least 5 units, standard rental housing, not shipping containers. And for anything that might have any commercial or other component into it, they want that to be less than 30% of the total area of the property. So, before we get into some of the further details over here, why does a lender utilize this and why does it make sense? Well, the reason why lenders like CMHC financing is because you as the borrower have to pay an insurance premium on the initial underwriting of the loan to CMHC, and they basically guarantee to the lender that if there's ever a default, that they will be made whole. And this is a very key important aspect for them to basically protect their downside risk. But also, it's because for most CMHC mortgages, they're not necessarily held on the balance sheet of one of the underlying banks that's writing the mortgage. Basically, your mortgage, similar to a bunch of other mortgages, all get pooled together. And if you guys remember mortgage-backed securities from 2007, 2008, 2009, what happened in the US, it's basically what they do here. They take a bunch of these commercial mortgages, they put them together into a bond, and then they sell it off to investors. And, about 1/3 of these goes to foreign investors. The other portion is sold to people who want consistent income in retirement. And usually that's the seniors of our society. And again, why they're able to do that is because they can protect that if there's ever a default, the government or CMHC will pay that out. So that's why lenders like it. They get to package it up, they get to take it off their books, and they get to earn their fees right away. And that's why from a lender standpoint, they want you to take CMHC because it's just they earn service fees on it with no risk to them. And as a result, from all those fees that they earn, they're able to sometimes provide better underwriting than they would if they were using their own money at risk. So what's with the standard program? Well, the maximum loan to value for construction is either 85% of the lending value determined by CMHC or 100% of the cost, whichever is less. So that would be based on appraisals and underwriting done by CMHC. For a purchase, it's up to 85% of the purchase price or the lending value is determined by CMHC. And notice how none of this has appraisal value. It's because CMHC will use your inputs that are certain inputs from your appraisal, but they will do their own underlying value assessment of your property before they lend on it. And then for refinances, up to 85%. And again, you can do purchase and refinance with improvements up to 85% of the as is or as improved lending value as determined by CMHC. So as you're buying a property and going to CMHC, you can say, hey, I'm actually going to be turning it over. I'm going to need XYZ amounts, and this is what my rents will be afterwards. And once you show that and prove it out to the lender, they will look to advance it. Again, you'll have to find a lender who will be willing to hold this on their balance sheet until kind of this process is done before they package it up and they obviously sell it off as a bond. And so how does the loan kind of get advanced? And a little bit, I got kind of skipped a step here. For construction financing, during the construction, they'll lend about 75% of the loan to cost or the lending value, with a lot of the items mainly being when they hit certain thresholds for rental income achievements. So whenever you're using construction financing through CMHC, you actually will need more than just, let's call it the 15% of the lending value, because you need a buffer between the time when CMHC will fund you and when you might get rental achievement or hit certain targets. Again, as you see here, there's like a quality cost surveyor that'll get involved in reviewing your costs. It must be done under a fixed contract, and there's like a construction management agreement. And again, first and last advances must be approved by CMHC. So for a while, you're going to be out of pocket, and you're going to have to cover that. So make sure that if you are going CMHC financing for construction, especially through the standard program, you are buffering in cash for more than just 15% down. You might hear it a lot, people saying, "Oh, just put 15% for your construction costs," but you're probably going to need closer to 25% of your total build cost as you're going along your project. Again, that's to keep your trades happy, keep your project rolling, and also meet your lender requirements. Where we as Foundation Capital fall in is more under the purchase and refinance area of this, where we are buying properties with improvements. Rental income is not going to be really disrupted during this time period. And so depending, they will lend either 75% of the improved value. Again, that's the value that they determine, or 85% as the as-is value. Again, CMHC will do a calculation of what your value is, and we will have a separate video on how CMHC does do that calculation. But those are kind of the factors that go into the standard program. And then where you want over 75%, it really depends on your rental achievements when you're doing new construction. Now, as it comes down to sort of minimum debt service coverage ratios, borrower net worth, and all that good stuff. So for basically multifamily properties that we're basically focused on, which are units above basically 10 units, we're typically looking at a minimum DSCR of 1.2 to 1.3. So again, if you are less than 10 years, you're looking at DSCR of 1.3. Properties with for more than 10 years is 1.2. If you're doing smaller units, they'll give you a lower DSCR. Again, here, when you're buying it, it's 1.1 on purchase, 1.2 on refi. So this basically says that, on refinance, CMHC is going to let you take out less money on 5, 6-plex units, but they'll let you take out a lot on a purchase. And then obviously when it's above 7 units, they don't really care. There's just an overall threshold based on how long the term of the mortgage will be. And then where you have rental units with non-residential space, which is commercial, that component uses a higher debt service coverage ratio. So when you're buying mixed use, they do give you a lower loan amount. The benefits with CMHC is predominantly they are fixed interest rate, or they're floating with the ceiling rate. So in our experience, what we've typically gone in is fixed mortgages, or there's like a ceiling rate, and you have to buy it down to keep the loan under that kind of that ceiling floor. Why people go towards CMHC is because, unlike the typical banks that do 25 years, CMHC will let you finance up to 40 years for existing properties under the standard program, and 50 years for new construction. And there is an extra charge that they charge for that. And a very important one that people need to consider when they are buying a property is that the amortization period must not exceed the remaining economic life, as determined by CMHC. So usually for that, they'll look at an appraisal, they'll get you to do a building condition report, all that good stuff. And so you want to make sure when you're working with your consultants, what we also do is make sure that there is enough economic useful life that when we are buying it and then we're turning it around and then refinancing it and say we're going to CMHC afterwards, that there's enough time between when you're turning it over and then going to refinance that there's still an economic life up to the maximum amortization period available. Again, CMHC will do first mortgages, and then usually they will allow pari passu second mortgages, which again, you can put a second mortgage on it afterwards as they allow, depending on the lender's requirements. But then you can get a second pari passu mortgage, which matches the terms of your first mortgage. With CMHC, you just have to pay more fees, and it's a whole process. But that's kind of what we look to do when we turn over a number of units in a building and there's enough capital for it to justify the cost of pulling it out. So why isn't everybody and their mother really going towards CMHC and doing this? It's because there's a lot of, requirements that are involved. But also one of the biggest ones is that you need to have a minimum net worth equal to the 25% of the loan amount being requested with the minimum of $100K. So this doesn't sound like a lot, especially if you're getting into larger buildings. Initially, when you're looking at hey, I'm buying a 12-plex for $2.6 million, $2.7 million, you're like 25%, yeah, I got a couple $100,000. But really, when you consider as the borrower and us as the general partners for the REIT, when we're going for bigger deals, let's call it like the $100 million deals, we have to show that we have at least $25 million in net worth in order for us to be able to qualify for it. And one of the things the lenders also look for is not just necessarily just we have the net worth between our homes and mortgages and stuff like that. Unfortunately, they also exclude our FCP rate units towards the value. They look for a lot of liquid cash, whether we have cash on hand, whether we have stocks, bonds, other kind of stuff that's liquid, and that's what also goes towards it. And they mainly look at, let's call it the liquid items, because they want to see liquidity. Again, for CMHC just provides the insurance, they just want 25% being met. But your underlying lender will have more stricter requirements where they're like, well, what happens if you don't cash flow? I get it. It's the property's under the REIT, but you're the borrower, and we have to go after somebody if something has happened. So they will typically look for you to have that cash kind of available. There's guarantee requirements, and this is something that we do as the general partner in the REIT and as trustees. If there is ever a default, CMHC does require that 40% of the outstanding loan, we do guarantee it. So if, for example, Russia attacks Canada, no one wants to live here anymore, America invades Canada, all the tenants leave our properties, it's going vacant, we're defaulting, everything under the moon is happening. Even if they go and force and sale the property, CMHC will still come after 40% of the loan amount from us. And then depending, they might reduce that to limited recourse if the loan value amount is lower and depending on the borrower. And this really comes into place when they're considering that there are other organizations like not-for-profits that are looking to get CMHC financing for affordable housing or other for-profit housing, and so it's hard for them to have someone who's going to guarantee it, because one of the other bigger factors also is, as part of you guaranteeing these loans and they're being recourse, is that it does go on your credit bureau. A lender will look at it. It totally impacts us when we go to get mortgages. So it's something to consider, that even though it is under a corporation, they will tag you personally when you are going under CMHC. This is definitely not something that they do when you get financing from a bank under a corporation. We've had mortgages from BMO before, and they'll tag the corp, and they won't put any recourse on, sometimes at times for you as the borrower individually. So again, these are some considerations you have to have when you're deciding if you're going to actually go the CMHC rental standard program here. And then for construction financing, you got to guarantee 100% of the outstanding amount until it's sort of stabilized for a 12-month period, and then it comes back down as well. Again, basically, because a lot of this debt and stuff is being sold off to seniors and to other third parties after it's underwritten, the lender or like the bank is basically servicing the loan. They're collecting service fees for that. So they put all these in place so that it fits this criteria, and because all these loans fit under these criteria, they can package together and sell it off. So that's the highlight of the CMHC Rentals Standard Program from a high level of what it entails. What we'll go through next is going through the CMHC MLI Select Program. And from there, we will then go towards comparing standard bank financing, CMHC standard rental housing, and CMHC MLI Select financing. So stay tuned.